Hello, everyone, and welcome to another Block Chat. This time it's the 111th episode, and we're going to be talking about something very, very interesting, especially for a person that's very dear to me, Makram, Hani. Um, the topic that we're going to be discussing today is very much in the real estate realm. So everybody who enjoys real estate really deeply will enjoy this topic so much. Makram, how are you? How are things going in Dubai?
I, I can't stop laughing. Amazing. Dubai is perfect, just perfect.
That's great. So, what
Sorry,
are
so
we
why are we
going to be
laughing?
talking about today? What are we going to be
We are
talking
talking
about today?
about,
Tell me.
today we're talking about tokenization, the difference between single unit tokenization and institutional unit tokenization, the opportunities and challenges that lie in between both, and why is one different than the other? What should we do? What should we do? What shouldn't we do? And how should we do it?
Amazing. And I believe a lot of our audience is going to enjoy this. But for my curiosity, if I may, take a step back, just initially, can you briefly tell us the difference between one asset type and the other one? So the single unit versus the institutional asset. Can you tell us the key differences between those two?
So I'll tell you the long answer, guys. I'll talk as fast as possible because we have very limited time and it's a very big subject. So you can slow me down if you want on your YouTube. So guys, there is whatever we're doing in tokenization over the past few years, all the effort that we've put, all the studies, us and everyone else in the business, and at Blocksquare, we've put significant effort into that. We've just been scratching the surface. Why? Because tokenization as a layer is the surface. What lies under it is what deals with the asset class itself. The underlying asset class is real estate. Thus, that's what matters. If you have a successful real estate investment, you will have a successful tokenized real estate investment. If you don't, you don't. Um, I'll answer the difference between both asset classes or both types of asset class. And before that, I need to say that within real estate, there's multiple categories of assets within the general asset class, and each is a totally different dynamic, from risk assessment to valuation to type of return to how it cash flows to what type of cash flow should it provide and what type of investment it is and it can resemble within your portfolio. Now, and that's the beauty of tokenization. Rather than you needing $200 million upwards to own a piece of each of those asset classes, you can, with tokenization, simply have a bit of all with less than $100,000. So when we talk non-strata assets, it's generally assets that are single buildings, that are multi-family properties that are usually a single title deed or treated as a single title deed. We call them non-strata in the business, and those assets resemble certain opportunities and do not represent certain challenges that are existent in single homes. I'll give you an example. Single homes, as you all know, it's a property, an apartment, or a single house or a townhouse that you own and you have the title deed of, and it's part of a bigger community. Now, it can be non-part of a bigger community. Where I stay, it's mostly a part of a bigger community, but it can be in the US and it's a standalone single-family home. And here comes the pros and challenges, which we'll talk about in a second. I don't want to jump courses so much. The main subject that got this out is what's the underlying asset and how can it be managed. If you're buying a token of an asset today, there should be things that are done. Who will do them? How can the risks that do connect to the process as well as to the asset category be mitigated? Which is something that regulators care much about. We care much about because we want to make sure that everything we're developing is something that my father can buy, your father can buy, you can buy, and so on and so forth. So The main differences in the asset class is the size. Usually, single-family homes are one home, one apartment, a single asset. It's part of a strata or not. While an institutional asset class, which is a non-strata asset, is a unit that consists within it multiple units, and it's usually one title deed or one single deed of ownership. I hope I answered this, Dennis. And would you like me to go through the rest, or would you like to take it through yourself?
No, I think it's good. Look, now the camera switched to our normal position. For those who usually listen to block chats, you can see that I've done the introduction for the first time with Makram, and
This is
that's
why we
maybe
were
why he
laughing in the
was
beginning.
why you were laughing at the beginning. Yeah, but definitely, I mean, understanding the underlying asset you're investing in is the key thing. The tokenization doesn't change that. It's just a form that it's digital versus otherwise investing in a property in a different form, which might be as well wrapped up in a digital format through a platform of sorts. But usually, the actual ownership is represented by paper of some sort. With tokenization, the fraction of your ownership is represented by a digital token that once you exchange it, you basically sell it and you don't hold those rights anymore. And I think that kind of difference is the one that a lot of people don't understand when they compare tokenization to kind of traditional vehicles. But nonetheless, as you say, Makram, the most important thing is what is being tokenized. And based on the market today, you see single units versus institutional assets. What type of assets do you foresee will find the biggest traction in the market in tokenized form?
Okay. Again, some of my answers people don't like, most don't like. The biggest traction is for one of the worst asset classes to hold as an investment. I see the biggest traction to come from hotel apartments or branded, fully managed residences. And we'll talk about why and what and how now. However, generally, those are the least efficient assets to hold as investors. If you're an investor, in a strata format, in other words, owning a unit in a hotel is one of the least efficient, least productive assets you can have. Now, owning the hotel in full in a non-strata is something else. That's not what we're talking about here. We're talking about owning a unit in a hotel or in a fully managed, maybe branded as well, residence. Now, why will those be the most, sorry, I forgot the word you used, but the ones that capture the most traction? The ones that capture the most traction because people like it, it's a sexy product. At the same time, regulators like it because it eliminates many of the risks. Today, property management and portfolio management are significant risks. Yeah, possibility of ignorant or malice from property managers who may not have fiduciary responsibility is a major part of risk, and regulators need to risk, and companies would like sometimes to eliminate risk. So that's the asset class that will have most traction. I call that exchanging the non-efficiency in the format, in the conventional form of fractionalization, and making it a non-efficiency that exists in the asset class itself. So I'll give you a for example here. If you are a crowdfunding platform in Dubai, licensed in DIFC, you cannot fractionalize yet. You cannot crowdfund yet hotel apartments or fully managed residences. Now, they have their own reasons, but I believe that that's good. Now, they're also tokenized or fractionalized commercial properties. They have their own reasons. I believe that should be really relooked at, and it's being relooked at now. But when we talk hotel apartments or fully branded and fully managed residences or fully managed residences, generally you lose that ability to have an efficient product in a conventional way. That is transmitted itself through the efficient way tokenization, and the non-efficient investment you have is transmitted as efficient as possible to you. So if you would like to have a transmission of a non-efficient investment to you in a very efficient way, feel free to use that. Now, the best probably today that looks the best, acts the best, is most beneficial, and probably is the most realistic as we speak today, is institutional assets. Why? Generally, those assets are single tenants or multi-tenants. However, they're fully managed. If you have a property manager with a fiduciary responsibility, or you have a company that has a fiduciary responsibility overlooking such an asset, you're able to tokenize it, tokenizing a very good asset with very good cash flows, very healthy cap rate, and passing on that great investment in a very tokenization to the end user and to the end investor. And that's what is ultimate. Now, still, can that be done with single family homes? Yes. Single family homes do not stand as good an investment as a $300 million unique opportunity of a multi-family complex. That's why people who do have those hundreds of millions, or one of the reasons, because there's many other reasons, scalability and do not go for multiple single family homes. They go for complexes like that because they can achieve an economy of scale, they can scale better, they can achieve a bigger efficiency in operations, and they can create an impact where they want, and they won't be impacted negatively by any neighbor who has a negative impact at any moment of time. Now, can this mean that, or does this mean that single family homes are not good for tokenization? Not really. They're great for tokenization. However, there's risks that we need to deal with. By the way, and here I need to say something. Over the past few years, we've been studying this as a team, and every single member of the team have been putting an effort on. And it happens that in this team, I'm the guy who's a real estate guy. But you can't imagine how positively surprised have I been. Once I came and thought of a challenge, I discovered that the team had already thought about it 3 years back and fixed it. So one day I came to the guys and I said, to Denis specifically, and I said, you know what, there is a big issue that is here. And this leads to a bigger issue with inheritance. And this is where it stemmed from. And then said, oh, really? Yeah, we fixed this 5 years ago. So it's amazing. And they're not. Denis has some real estate investments, but he's not a real estate investor full time. That's not what he does. He does something else. So that's amazing. Still, all of us in the industry have only touched on the surface. We have worked on much of what's below the surface. We have worked on the methodology, on the terminology, on the standardization, on all of those. Yet we still need many other elements to make us get there the right way. Obviously, regulatory frameworks can help us, but we need property managers with fiduciary responsibility. And that's why one of the reasons I came few months, actually a year and a half ago, and we came up with a property management company that has or will have a fiduciary responsibility, because currently legally that's not the responsibility that they have. But that's a property management company that does nothing but a property management, because in my opinion, a property management that does brokerage have a conflict of interest within the property management framework. A property management that does anything else of the several, like facility management or any other type of services, has a problem, has a conflict of interest within its main service and the other services around. So what we believe there should be is a record of everything from the day the apartment gets built or designed, built, tokenized, and beyond, including the utilization of IoT and AIoT, and the record of every single instance and incident. If a property flooded, you can see it on chain. If anything that happens can immutably be recorded on chain. And if you have all of this, you have a track record, a perfect track record of an asset that makes and allows you as an individual to see the history of performance. It allows you and the regulator to make sure that the distributions are happening right. There's no inefficiency, there's no mischief, there's no ignorance, there's no neglect. There's nothing that can pass through and pass as if not noticed and reach the end user and the end investor. And by this, we make that property, the single family home, tokenizable in a healthy manner. When I wrote the paper on that and I published a brief about it, Dennis, I wrote it because I felt that and I saw that regulators, for to avoid those challenges, rather than going for institutional type assets, because there's a challenge there where there's very few assets that can come on chain directly, probably, they went for hotel apartments. They went for fully branded managed residences. So it's not a product I would like to tokenize. I own hotel apartments, and I can manage them very well. But I'm not sure that that is an asset class that people do want if managed fully with the non-efficiency that exists within that space. And don't understand me wrong. One day, somewhere, sometime, maybe today, someone has a hotel apartment product that may be very decent by structure. But generally, that does not exist or exists for a certain type of investors, which is overseas investors who want access to the property market, do not understand it enough, and do not want their hands on it enough. Is that the ultimate product? No. I wouldn't say it's a bad product. I say it's a product that serves a simple purpose. It's similar to a fixed deposit in a bank. Is it a bad product? It's to some it would be, to some others it wouldn't. It serves a purpose or wouldn't. The ultimate is an institutional investor, institutional style investment, where it's properly managed. And that does not have to be huge. The proof that it doesn't have to be huge, it doesn't have to be a $500 million investment, is the students' housing that we have in Slovenia and Ljubljana today. And yeah, maybe that's not an institutional size bag, but it resembles something like that. And if you have something like this, but slightly bigger, on a 50 million, 60 million euros, you would have an ultimate asset class that can be perfectly and efficiently tokenized and presented to people.
Makram, wouldn't you argue here that when it comes to property management, it's about the efficiency of that property manager? So, and the efficiency, of course, it comes with scale. So when you manage a single unit, whatever that unit might be, the inefficiencies come because certain things, like how quickly you have maintenance there, how well it is, how well it is maintained in terms of cleanliness and stuff like that, where it might, common areas might need that attention. How often is it kind of maintained in terms of, you know, any I don't know, paint jobs or any other repairs that might need to be done, and you know, just regular maintenance stuff, right? From the light bulb to the whatever it's needed in the attention, and the time it takes for that repair to happen. And of course, small operations are outsourcing most of it, so the overhead of that cost is usually bigger, right? While as you scale the operation of the management, you can have more and more those services in-house, which kind of then reduce the cost of that item. And it's not so much about institutional size as much as it in terms of units. You might have a portfolio of 1,000 single units within a specific region, and it might be very efficient because the product is institutionalized in terms of how it is being managed, even though an institution might never go and buy into that type of product. But maybe a private investor would, because of potential liquidity when, you know, dealing with that portfolio. Having 1,000 single units, it's much easier to readjust your investment into those units if there's a downturn coming up and maybe you want to kind of divest from a specific amount of units. And so that's a flexibility that on the institutional side you don't have. You don't have the ability to just sell a 300 million complex, whether it's a multi-residential or, you know, a hotel or whatever type of it is. You will always face discounts on NAV when you start entering that deal, at least in the initial negotiations. Maybe down the line, over time, down the line, you might get the price you are actually searching for, but the exit is permanent. And usually the exit is 100%. It's not like you can exit 20%. Whatever buyer will come with their management strategy, and they will want to bring additional efficiency to the asset, or just change it for some reason. And so is that maybe the reason why institutional assets or institutions operating and owning those assets might even turn to tokenization? Or you think that liquidity in institutional assets is not a problem? Because then we have a problem. Either we have institutional assets, but nobody wants to tokenize them, right? And then whatever's left on the market is single units, because of some reason that you have different types of single units, and some single units are large enough in or too big in value to find quick liquidity on the markets, or to find liquidity. Like I always say, here in Slovenia, assets of 3 million plus up until 20 million are very illiquid because there's not many buyers. And so what do you think will be the challenge bringing those institutional assets through tokenization to the market? And what's the main driver going to be for the owners of those assets to actually do it?
So first, let's talk about the efficiency. 100%. We're not trying with tokenization to change all the characteristics of the asset class underlying. If there is an asset class that is non-efficient or so efficient in the underlying, when you tokenize it, it will stay as efficient. Okay, you shouldn't be changing that characteristic. So an institutional asset class, because of scale and many other elements, in general is more efficient on the operations than a single family unit, especially when it comes to strata assets, when it comes to condominiums, when it comes to apartments in a complex, because usually there are service charges or condo fees, depending on where you are in the world, that do impact also your operating efficiency. Now, that said, the answer about will institutions be interested to get institutional assets to chain, 100%. I believe today they need a proof that there is enough liquidity on chain. Around 3 or 4.5 years ago, if you remember, Denis, we've done a pilot, not a pilot. We've done something with Skanska Labs. Skanska is a huge company. They had a small experimenting, and again, I'm not sure here, by the way, if we should use the name. Even I shouldn't have said the name. We beep it, guys, in your heads. Okay, so we did a test with a big company.
By the way, if Makram says something, doesn't mean it's true.
Exactly, 100%. That doesn't represent the opinion of the organization or anything further. So
yeah, who's this guy?
Exactly, it's only just a guy. So that situation turned out to say, if there is proved liquidity, if you can get enough liquidity to liquefy an asset class which is of such a size and of such a magnitude on chain, they will come to chain. The proof to that is that they do and create REIT and fund structures, because although it's higher cost and just because there is liquidity there in that market. Okay, if you list today a trust on the markets, it will be fully subscribed to. A proof to that, Dubai Asset Management a few days ago have listed, if I'm not mistaken, few billions. I don't want to give a number here, just not to give a wrong number, because there's so many numbers in my head. Few billions of an asset, of an asset portfolio on Dubai stock market, and it was oversubscribed by. That's a proof that you have interest in such asset classes and in such categories of an asset class. We need to prove to such organizations that there is liquidity. There is a talk today about liquidity, and we always talk about liquidity. I said it before, I'll say it again. I believe the minute we get a proper asset that is a great quality investment on chain, people will eat it as if it's hot candy, hot cake, or cold candy, or whatever. Okay. You remember we talked about we were talking about the students' housing in Ljubljana, and you said, you know what, if it was in Dubai, and because people want hot markets, yeah, and people follow hot markets, and if it is a sexy market and a good asset at the same time, because that's a good asset, but not in a market that everyone in the world knows. Someone in China would not be looking at Ljubljana as, I dream of owning a house in Ljubljana. Now, trust me, if you know Ljubljana enough, you would love to buy a house in Ljubljana or anything similar. But still, that's not but their dream is to buy in New York or London or Dubai or Singapore, and those are dream cities to buy into. So the minute we get such assets on chain, you will have, and you will see the impact and the liquidity that's available there. It starts showing in research that have been done by Deloitte, for example, a few days ago, and several other pieces of research, like by other big fours and the likes. So there is great liquidity and great quality and quantity of assets coming on chain. It's only what type of assets do we want to get on chain? Do we want to get lousy assets on chain, or do we want to get great quality assets on chain? And our question today is single family homes or institutional. Both are good to come on chain. They represent different products, and they represent obviously different categories of. Here, I'm not sure if you're hearing me still, Dennis. Are you hearing me? Dennis, are you hearing me?
Yes, we hear you. We lost you
Dennis,
for
are
a
you
second. I was just thinking.
Okay, you lost me somewhere. Okay,
Yes,
so
I
I was
lost you
saying,
somewhere, but I'm not sure where. I'm not sure where.
I
Usually
can
it
figure
happens
out
to me.
probably
So
that.
today, so today we changed the role completely. I did the introduction. I did the Makram. You did the Denis fully. Like you're speaking most of the time, and as well you're losing the connection. So well done on the impersonation of myself. I think I didn't do half the job that Makram did when it comes to being me or him. So now switching back, I guess, the
So
sides. Um, yes.
So here I was
Go
saying
ahead.
that
I
both
think now
assets are
we've
good to
got you
come on
back.
chain. Each asset is different in its characteristics. If we want to get anything on chain, we need property management with fiduciary responsibility. We need trust to be transmitted. We need to protect the end user so that we do not create a gap of. For us to call it trustless, really trustless, and as we described trustless in the past, it's not without a trust, it's without the requirement for trust to exist. In other words, it's something that you can trust without needing to trust. I'm not sure how much does that make sense, but it should. Okay. The ability of ours to transact in a trustless manner, to purchase tokenized assets in a trustless manner, depends on standardizing processes, terminology, methodology. And here, when we talk about ability to understand different asset classes in different pieces of parts of the world, we understand how they're tokenized, how they're managed, every single contract, although it should be adapted to local regulation, every single element of the asset and how it's dealt with, maintenance, service charges, and all of those, how it's dealt with, collections and distributions, and how it's dealt with. When we deal with all of this, and by the way, at Blocksquare, we've on paper dealt with all of them, and we've on ground dealt with most of them today. There are new things coming up, and every single thing that's coming up, we're dealing with. And when regulatory frameworks helped us enough, we today probably can deal with all of those. To have single family homes safely tokenized and on chain, to have institutional assets safely tokenized and on chain. And that is what Dubai today, for example, is doing a great thing. In July, tokenized in the world, where the register is fractionalized, where the tokenization is impacting the register directly. One caveat here is that it's a hotel apartment. It's a fully managed hotel apartment, which is gives me pain. Everything else is amazing. Again, that asset, I'm not saying it's a bad asset. I'm saying that I would love to have a different asset that's my liking.
Look, Makram, a lot of things start small. And like the first asset we've tokenized was a single parking space. And it's a single unit, right? And it has its challenges when it comes to managing it. Thankfully, it's a parking space, so you don't need to really manage it. You just need to have a lease contract in place with someone who's renting it out. But it's a small, single unit. And from there, we were able to, develop a lot of what Blocksquare is today. And I think this kind of small steps that you mentioned are just, that proof of concept that, things work, and there's not much being at risk in the end.
Exactly.
But going back to institutional assets, right? So one thing that we have been encountering and regularly at Blocksquare is we see a lot of projects that come to us that don't really own real estate. So there's a lot of projects that come, but they want to use tokenization to acquire real estate. And these are one of the most complex transactions ever because there's, like you mentioned, there's a lot of unknowns, a lot of uncertainty in the process. Do you see these institutional assets going to be tokenized as something that will require that change of ownership for this to happen? So again, using tokenization for raising funds to acquire an asset versus tokenizing an asset to find liquidity on the market.
My view here is that any company that would need to raise any funds against a future planned to be owned asset, regardless of the type of asset, it means that that company is entrusted with those funds for that period of time, needs to have a fiduciary responsibility. It cannot be a media agency and pools money of people. It cannot be. I'm not saying that they're bad people. I'm not supposed to do that, and I can be a good person. But the whole idea is you cannot allow human beings in general, all of us, to do actions like that, because actions like that cannot be monitored and controlled are very dangerous and very risky and may make very good people suffer. And remember, will say it again, people with fiduciary responsibility or companies with fiduciary responsibility do not eliminate all the risk. There still is risk. Bernard Madoff had fiduciary responsibility and searched for those billions in the most legal way you would like to. So fiduciary responsibility does not resemble no risk. It just limits the risk, because if people are monitored, if operations are monitored, if how you're raising is monitored, if how you're mandated and what you're mandated to do is monitored, and if performing that is monitored to a certain level, then it is safe enough. Whenever it is raising money for buying an asset that will come in the future, this is the main risk. Now, there is many other risks that can be eliminated by our process today, Denis. So today, we have been clear with all parties who want to raise money using tokenization to purchase an asset, that they need to define the parameters of that asset, of the income, of how will it be done, what is the entry, in a very clear way. So it's clear to the public, it's obvious to the public. However, if anyone is doing it from a regulatory perspective, in my opinion, they will need such an organization to exist, unless they're using a very simple structure, which is a different thing, or unless you're using a very complex structure, we think that fiduciary responsibility to another entity in the play. The ultimate for us is, and here probably the question that you've asked is, where will those assets come from? Who will get? Will companies be raising money to go buy the assets? They don't need to. there is asset owners today, rather than them selling it to or searching for the institution to buy it, they would tokenize it and sell it to the public. At the end of the day, institutional asset buyers need institutional asset sellers for the whole transaction to exist. What I'm saying is that the tokenization does not have to happen on the buyer's level. It can happen on the seller's level, where tokenization is a means to liquidate, is not a means to acquire. It can be both. I'm not saying it doesn't have to be both, because, and that's the beauty of tokenization. It can do many things. It can be worked around in many ways, in a very transparent way. Anything can be reflected in smart contract. At the same time, you can use it at any part of your capital stack you require. You can use it as senior debt, junior debt, mezz debt, preferred equity, common equity. It doesn't matter. Yet, there is no challenge, in my opinion, in that. The minute that you are able to safely tokenize assets that are $100 million a piece, you will see sellers of those assets interested to tokenize them. They're hoping that the retail buyer or the institutional buyer coming to invest $5 million through tokenization in their institutional asset will not scrutinize and negotiate the transaction as harsh as a fund that has $1 billion and is coming in to buy. They would hope for that. It doesn't have always to be achieved. At the same time, money, as we know, does not disappear from the world. At times where there is crunches, at times where there's busts, liquidity in capital markets is limited. And that in itself affects how institutional assets are sold, how commercial real estate is sold. That said, it doesn't have to swim down to every retail buyer. So if you have an institutional asset tokenized at that time, most probably you may have as much interest from everyone else in it if you are presenting a decent product that cash flows well and that is decent as a real estate product.
So to summarize what we talked today, so just to be mindful of the time, right? Because we want to hit that 40-minute tops every time.
Yeah.
Single units versus institutional assets every day. And why will these institutional assets be tokenized and offered on the market? And why do owners of these institutional assets have a need for tokenization to actually come to life? Is the exit side that can be partial. It can be at NAV, not below. So they don't need to deal with discounts and harsh negotiations. And it's in their interest, in a way, to make this happen, this market happen, because it's going to bring benefits to it over the traditional way of buying and selling real estate in the end. And whatever the asset type, management. So property management needs to be top notch. So whether it's a single unit or an institutional asset, if it's properly managed, it's probably going to yield a better result for investors, whether they buy into it through stocks, through a REIT, or through tokenization in the end, right?
100%.
And
I believe they will choose tokenization.
Any last remarks, Makram?
That's it. I hope we shed a little bit of light. Message to our community and beyond. Yeah, we love you all, guys. Thank you all for being part of us, and we thank here the team. Thank the team, all the team members who are putting. Oh, look at Denis's t-shirt. Bullish.
I just remembered I have the t-shirts on me today. So on my end, thank you everyone for being with us. Thank you for being part of our energy, and we are part of your energy, as Makram says. Blockchat 111 is done, and we're gonna see you on the next one. Thank you so much for being here.